One software update could trigger the biggest crypto adoption event in history, and it just shipped to production on the XRP Ledger. Not a tweet, not a press release, not a conference keynote with a countdown clock and a marketing campaign. A code merge, a version increment, a protocol amendment that activated on the XRP Ledger and quietly delivered the single piece of infrastructure that every institutional compliance department in the world has been waiting for since the first conversations about tokenized real-world assets began behind closed doors more than 3 years ago. The XRP community heard about it, and most people scrolled past. The mainstream financial media did not cover it. The crypto press treated it as a minor technical milestone. And in that collective shrug, the retail market missed the single most consequential infrastructure development in the history of the network. The moment when XRP stopped being a payment settlement asset competing for institutional attention and became the regulatory, compliant tokenization layer that the institutional financial system has been trying to find for half a decade. But this is the part almost nobody understands. Tonight, I'm going to walk you through what this update actually delivered. I'm going to explain why the specific functionality it activated changes the institutional math for every bank, every asset manager, and every tokenization platform that has been evaluating XRP as a settlement option. I'm going to connect it directly to the Clarity Act, to Evernorth's 423 million XRP Treasury deployment, to the DTCC's Project Ion T+0 settlement option, and to the macro environment that has been quietly converging on this exact moment for 2 years. And I'm going to show you why the price you see on the chart right now is not a reflection of what has been built. It is a reflection of what the market has not yet noticed has been built. Before I continue, this is not financial advice. I'm sharing publicly available information for educational purposes only. Always do your own research and consult a qualified financial professional before making any investment decisions. Now let's begin. The software update at the center of this story is the XRP Ledger's permission domains and compliance functionality that activated through a recent protocol amendment. To the casual observer scrolling through release notes, it looks like a feature addition. To the institutional architect reading the same notes with the compliance department's eye, it looks like the missing piece of infrastructure that the entire regulated financial system has been waiting for. Because what permissioned domains and compliance functionality on the XRP Ledger actually unlock is the ability for regulated institutions to participate in on-chain liquidity provision, settlement, and asset transfer within environments that satisfy their statutory obligations around customer identification, anti-money laundering verification, and counterparty due diligence, all natively at the protocol level without bolting on external compliance layers that introduce custody risk and operational complexity. And this is where the story becomes dangerous. For years, the conversation around institutional DeFi has had a structural problem. The DeFi ecosystems that exist on public blockchains, the Ethereums, the Solanas, the Avalanches, operate as permissionless networks. Anyone can participate. Anyone can deploy capital into any pool. And from a compliance perspective, that openness is precisely the problem. A bank cannot legally provide liquidity into a pool where the other participants are anonymous wallets whose origin and identity the bank cannot verify. A regulated asset manager cannot tokenize a treasury bond and place it into a trading environment where the buyers cannot be identified. The compliance frameworks that govern these institutions are not optional, and they cannot be retrofitted onto permissionless infrastructure without compromising the design that made the infrastructure work in the first place. The XRP Ledger's solution to this problem is the part the retail community has not absorbed. Permission domains create the structural compromise that the institutional world has been demanding for half a decade. Within a permissioned domain on the XRPL, only verified institutional participants can transact. The compliance obligations are satisfied at the protocol level, and critically, those permission domains exist alongside the permissionless functionality of the broader ledger, meaning institutional participants get the regulatory environment they need while still benefiting from the liquidity, the settlement speed, and the cross-border functionality that made XRP attractive in the first place. Now here's where things get serious. Because the moment this functionality went live, the XRP Ledger became the first major public blockchain in the world that delivers permissioned institutional environments natively at the protocol level with the regulatory compatibility that every Tier 1 financial institution has been requiring as the precondition for production deployment. Ethereum cannot do this without external Layer 2 compliance overlays that introduce custody risk. Solana cannot do this within its core protocol architecture. The permissioned blockchain alternatives like Corda and Quorum can do this, but they do it inside walled enterprise environments that lack the public liquidity and the open settlement rails that make XRP useful for cross-platform value transfer. The XRPL just delivered both permissioned institutional environments and permissionless public liquidity on the same network, in the same protocol. That is the structural achievement that the institutional financial system has been waiting for. And it shipped quietly, while the retail market argued about price targets and short-term chart patterns. But this is the part almost nobody understands. Let me connect this directly to the Clarity Act because the legislative timing of this update is not coincidental. The Clarity Act's Section 401, which authorizes every US bank to offer digital asset services without prior regulatory approval, is meaningless without compliance-compatible infrastructure that those banks can actually use. Section 409, which protects DeFi developers who do not take custody of user assets, is meaningless without permissioned environments where regulated entities can operationally participate. The legislation provides the legal authorization. The XRP Ledger's permission domains provide the technical environment that makes the legal authorization deployable. Without the technical infrastructure, the legislation is a paper unlock. Without the legislation, the technical infrastructure is an unused capability. The combination of the two is what produces the operational reality, where US banks can deploy capital into XRP-based settlement and liquidity provision on a regulated, statutorily authorized basis. That combination did not exist 3 months ago. It exists now. And the firms that have been preparing for exactly this combination are not waiting for the market to figure it out. Ashish Birla and Evernorth, with their 473 million XRP treasury, are positioned precisely for the moment when permissioned institutional DeFi on the XRPL becomes deployable. Birla's December 2025 prediction that institutional DeFi would reach a turning point in 2026, with regulatory clarity advancing and enterprise demand growing, was a prediction about exactly this moment. The technical infrastructure he was anticipating has now arrived. The legislative framework he was anticipating is advancing through the Senate. And his 473 million XRP deployed across validator operations, DeFi yield strategies, and the NASDAQ listing vehicle is the institutional bet on the convergence that the software update just made real. And what happens next changes everything. Now let me explain why this update is the specific catalyst that closes the gap between the adoption reality the institutional world has been building and the public price that has not yet reflected any of it. Birla said it directly. Adoption is taking off, doubling in many use cases, but price is lagging behind. The structural reason for the lag has been the absence of operationally deployable institutional infrastructure on a public blockchain that satisfies compliance requirements. Institutions have been doing pilots, they have been signing NDAs, they have been running test transactions on enterprise environments, but they have not been deploying production capital onto a public blockchain at scale. Because the public blockchain environments did not have the compliance infrastructure they required. That structural barrier just collapsed. Permission domains on the XRPL are the operational infrastructure that allows production-scale institutional capital deployment to begin. And the institutional capital that has been queued behind that barrier for years is not going to deploy slowly. It is going to deploy in the sequence that compliance departments have been preparing for. Mandate amendments first, allocation decisions next, and then capital movement at scale. Once the operational testing on the new permissioned environments confirms that the infrastructure works as advertised. Standard Chartered's projection of $4 to $8 billion in XRP ETF inflows by year end, if the Clarity Act passes, does not account for the permissioned domain unlock. That projection was built on the legislative catalyst alone. The combination of legislative passage and operational permissioned infrastructure produces inflow numbers that are meaningfully higher than the 4 to 8 billion baseline. Because ETF inflows are only one channel. Direct bank deployment for settlement and custody is a separate channel. Asset manager deployment for tokenized real-world asset infrastructure is a third channel. Corporate treasury deployment for cross-border payment optimization is a fourth channel. Now here's where things get serious. Each of those channels was previously gated by a different combination of regulatory uncertainty and technical infrastructure absence. With the Clarity Act advancing in the Senate, and the XRPL's permission domains now live in production, every one of those channels is open simultaneously for the first time. The market has not priced this convergence because the market is still reacting to each component in isolation. The retail community sees the Clarity Act news and reacts. The retail community sees the protocol amendment and shrugs. The retail community does not connect the two and recognize that the combination is what unlocks deployment. The institutional community connects them in real time, and the deployment that follows does not announce itself in advance. It shows up in the form of supply absorption, exchange balance compression, ETF custody growth, and eventually price discovery in the public market. Let me walk you through the supply dynamics that this convergence is loading, because the math here is more dramatic than most people realize. Exchange balances are currently at 2.6 billion XRP, the lowest level since 2018. ETFs hold 1.32 billion XRP in custody. Whale wallets accumulated 1.15 billion XRP in April alone, while retail was selling at $1.38. Evernorth holds 473 million XRP in its institutional treasury. The escrow releases from Ripple have been declining as the company uses less of the release supply for institutional sales, because OTC demand absorbs the supply before it reaches public markets. Stack those numbers against the demand catalysts that the convergence just unlocked. ETF inflow projections of $4 to $8 billion if the Clarity Act passes. Direct bank deployment capacity authorized by Section 401 for every nationally chartered institution in the United States. Permissioned domain participation by every Tier 1 financial institution that has been waiting for compliance-compatible infrastructure. Tokenized real-world asset settlement that requires a public blockchain with regulatory clarity and permissioned environments. A combination that only the XRPL now offers. And this is where the story becomes dangerous to ignore. The supply available to satisfy that demand is finite and shrinking. The supply already absorbed into institutional custody is meaningful and growing. The supply held by dormant retail buyers at the $2 cost basis is unavailable until prices approach that level. And the supply that exists at all is structurally constrained by the absorption mechanisms that have been operating in OTC channels invisible to the public price chart. This is the setup that produces supply shocks, not a slow price appreciation, not a steady upward grind. A supply shock, where prices must rise sharply to unlock dormant supply, where each price level unlocks a specific tranche of holdings, and where the public price finally reflects the institutional adoption that has been building invisibly for 2 years. Let me layer in the macro environment, because the timing of this convergence with the global macro picture is not accidental. Japan's reverse carry trade is unwinding. US Treasury yields are under structural pressure. The bond market is experiencing the kind of dislocation that creates institutional demand for neutral settlement assets that operate independently of sovereign currency dynamics. The Strait of Hormuz remains a geopolitical pressure point that could accelerate oil price spikes and intensify the pressure on Japan specifically. The Bank for International Settlements has been openly discussing the need for neutral settlement infrastructure that does not depend on any single sovereign currency. XRP is exactly that, neutral, independent of any single sovereign issuance, operating on a public ledger with permissioned institutional environments, authorized for US bank deployment through legislation advancing in the Senate, positioned for cross-border value transfer through technical functionality that no competing public blockchain currently delivers in the same combination. But this is the part almost nobody is connecting. The macro pressure does not just create demand for any settlement asset. It creates demand for the specific settlement asset that satisfies the compliance, technical, and regulatory requirements simultaneously. And the protocol amendment that just shipped to the XRPL is what allows XRP to satisfy all three simultaneously for the first time in its history. Now let me address the question that always comes up when this thesis is presented. Why has the price not already moved? If the institutional adoption is real, if the legislative trajectory is confirmed, if the technical infrastructure is now live, if the macro environment is favorable, why is XRP still trading around $1.46? The answer is the answer Berla gave to Paul Barron. Adoption is taking off, but price is lagging. The lag is structural. Institutional buying through OTC channels does not move public exchange prices. ETF accumulation through private negotiations does not show up in retail order books. Permission domain activation on the XRPL does not generate the same kind of social media engagement that drives retail price discovery. The institutional adoption has been building in channels that are deliberately invisible to the public price mechanism. That invisibility is a feature for the institutions accumulating. It is a feature for the firm's positioning. It is a feature for the architects of the system, who have every incentive to complete their accumulation before the public price reflects what they have been building. The lag between adoption and price is not a bug in the thesis. It is the operational reality that makes the thesis investable for those who understand what is happening underneath the chart. And what happens next changes everything. Eventually, the OTC supply available for institutional absorption exhausts. Eventually, the ETF demand exceeds what private channels can satisfy. Eventually, the deployment of bank capital under Section 401's authorization requires public market sourcing, because the scale of demand cannot be accommodated by negotiated private supply alone. At that point, the price discovery happens publicly. The chart reflects the accumulation that has been building for 2 years in a single repricing event that compresses what should have been a multi-year appreciation into a much shorter window. That is the supply shock that the convergence is loading. And the protocol amendment that just shipped is the technical catalyst that confirms the convergence is operationally real, not theoretical. Let me give you the investment calculator because the convergence math needs to be translated into concrete portfolio numbers. At $1.46, $1,000 buys approximately 685 XRP. At $2.80, Standard Chartered's near-term institutional consensus, those tokens are worth $1,918. At $5, the lower bound of the Post-Clarity Act year-end consensus, they are worth $3,425. At $8, Standard Chartered's upper scenario, where ETF inflows reach $10 billion, they are worth $5,480. At $12, the intermediate target, where BlackRock enters and the institutional ratio flip completes, they are worth $8,220. At $20, the velocity model, where bank deployment under Section 401 stacks on top of ETF demand, they are worth $13,700. At $28, Standard Chartered's 2030 institutional base case, they are worth $19,180. At $100, the level cited as materially altering institutional liquidity math for full DTCC settlement integration, they are worth $68,500. Scale those numbers to your own position. At $5,000 invested, multiply every figure by 5. At $10,000, multiply by 10. At $25,000, multiply by 25. The structural floor in the current technical pattern puts maximum downside in the range of 12%. The upside arithmetic is on a fundamentally different scale. Now here's where things get serious for anyone still waiting. There is a pattern in this market that has repeated through every previous catalyst. People wait. They wait for the legislation to pass. They wait for the price to break through $2 and confirm to them that the move is real. They wait for the headlines to validate what the institutional players have already deployed against. And by the time the confirmation arrives, the price they were waiting to enter at is several dollars behind them. The protocol amendment that just shipped is not a confirmation event in the public sense. It is a confirmation event in the institutional sense. The institutional players who have been waiting for permissioned infrastructure on a public blockchain have just received it. The institutional players who have been waiting for legislative authorization are watching it advance through the Senate. The institutional players who have been waiting for macro conditions to validate the need for neutral settlement infrastructure are seeing those conditions develop in real time. The market that you can see on the chart at $1.46 is the market that exists before any of those institutional players have had to source their full deployment from public exchanges. The market that exists after they begin sourcing publicly is not the same market. The repricing that follows is not gradual, it is structural. Now zoom out and assemble the full picture. A protocol amendment shipped to the XRP Ledger that delivers permissioned institutional environments natively at the protocol level. The Clarity Act is advancing through the Senate, with bipartisan committee passage already secured. Section 401 of the Clarity Act authorizes every U.S. bank to deploy into digital asset services without prior regulatory approval. Section 409 protects DeFi developers operating without custody. Evernorth holds 473 million XRP and is listing on Nasdaq through a regulated equity wrapper. Standard Chartered projects $4 to $8 billion in ETF inflows. Exchange balances are at $2.6 billion, the lowest since 2018. Whale accumulation continues at the pace of 1.15 billion XRP per month, while retail sells. The reverse carry trade in Japan is unwinding. The macro environment is producing institutional demand for neutral settlement assets that operate independently of sovereign currency dynamics. And this is where the story becomes dangerous to dismiss. Each of those elements has been developing for months or years. The protocol amendment is the technical piece. The Clarity Act is the legislative piece. The macro environment is the demand piece. The supply dynamics are the absorption piece. The institutional players are the deployment piece. The market that does not see how the pieces fit together is the market that will look back at $1.46 and not understand how it could have been there for as long as it was. The architects of this system have been positioning for the convergence. The legislators authorizing the deployment have been moving the bill. The developers shipping the technical infrastructure have been writing the code. The macro environment has been creating the institutional demand. The supply mechanisms have been absorbing the float. And the price has been lagging because the price always lags when adoption is happening in channels invisible to the public chart. That lag is not permanent, it cannot be permanent. Because once the OTC supply exhausts and the institutional players must source publicly, the price reflects everything that has been built. And what has been built is not a payment settlement asset. It is the regulatory compliant tokenization layer that the global financial system has been trying to find for half a decade. Software updates don't make headlines. They make history. And the people who read the changelog before the world catches up are the ones who get to write the next chapter. Smash that like button if this connected dots about the protocol amendment that nobody else has connected for you. Drop your XRP target. And whether you believe the permissioned domain unlock is the catalyst nobody is pricing, in the comments. Let's see what this community has priced in before the institutional convergence becomes visible in the public chart. Subscribe and hit the bell. Because when the Senate floor vote lands, when the presidential signature happens, when Section 401's 90-day window opens, when BlackRock crosses the threshold, and when the first institutional deployment into a permission domain on the XRPL becomes public, my breakdown drops within hours of each event. The infrastructure has been built, the legislation is advancing, the supply is compressed, the macro environment is favorable, the convergence is real, and the price has not yet noticed. See you on the other side.